So what stocks should you be buying? That's probably the question you're asking right now. Well, I'll tell you. Ones that you can sell for a higher price at a later date. Duh, right? But, you could easily say the same thing for any type of investment. I'm making a point here. If you're a house flipper, obviously the goal is to sell the house for a higher price than what you put into it. So what makes stocks different than houses in investing terms? Well, for one, unlike the stock market, you're unable to check the price of your house for every minute of every second of every day. Now, those of you who are homeowners might occasionally check the estimated value of your house on a site like Zillow.com. But of course, that's an estimated value. And in reality, the last price was what you paid for it, because there is no equivalent to your house and the lot that it sits on. But a share of Netflix stock, for instance, is a share of Netflix stock. You see, stocks, like dollars, are fungible. Stocks are also highly liquid, meaning you can unload them at about any second, and they trade constantly. About 6 million shares per day trade in Netflix's case. See, you can easily sell your Netflix stock at worst at the opening bell during the next trading day. That's not so with a house. That can take up to months and sometimes years for you to sell. A pain, frankly, I'm all too aware of. These day-to-day, minute-to-minute, and even second-to-second fluctuations in real stock prices, not just estimates, creates a far different psychological phenomenon for investors in the stock market versus in the real estate market. I've burned through several computer mice over the years from clicking the refresh button on my stock portfolio dozens of times a day, so I'm not immune to this at all. And when people wake up and see one of their stocks trading down 5% or more, they tend to flip the hell out. Comparing the Zillow chart to this Netflix chart during the same period, you can see the obvious fluctuations in both. It's also easy to see the Netflix chart and say, wow, I should have bought down here and sold up there. But in reality, there were a lot of ups and downs there you had to navigate psychologically. You see, none of these paths were linear whatsoever. That brings us to what I've always found is the most important component of any of my successful investments, and even more importantly, what was definitely lacking in my bad investments, and that is conviction. Ultimately, you must have conviction that the company whose stock you've bought will grow its earnings in the future. If you don't, you'll panic and sell your stock for reasons that are purely psychological and have nothing to do with your assessment of the business. You could also accurately call conviction faith instead, because as Martin Luther King described faith, it's taking the first step without being able to see the whole staircase. The critical nature of having conviction and faith in your investments, in my mind, exposes how useless so-called stock tips are. If your buddy tells you, hey, I've got a sure winner, CARP is the symbol, buy it now and watch it ride high. Now you notice that this guy doesn't tell you why it's going higher, just that it is. Also, he doesn't tell you when to sell the stock, which couldn't be more critical. And finally, a sure thing? Really? Come on, beat it, pal. But of course, when I'm talking about faith in stocks, theoretically pieces of paper, I'm not talking about religious dogma, which is really why conviction is probably a better description, because you must be willing to change course on a dime when necessary. There's a reason you bought the stock and have conviction in it. If that reason changes for very tangible reasons, you must adapt, which probably means selling some, if not all, of your stock position. Let me give you a good personal example that I can think of. Apple is a stock I've owned on and off, mostly on, since I began trading in 2005. When I initially bought it, I thought they had superior products to what Microsoft was putting out there. And really, frankly, the iPod was a huge thing. That took people who were in college at that time, like myself, by storm. I mean, everybody had an iPod. And then in 2007, my instincts frankly just told me that the iPhone was just a game-changing, incredible product. Mostly because I was personally just dying to have one. In my mind, there had never been another product like it before. I was completely mind blown the first time I got my hands on one of those things. These instincts gave me great conviction in owning the stock. Now, honestly, though, right now, for the first time since Steve Jobs' death, I'm starting to lose a tiny bit of conviction in Apple. Not enough to sell the thing, mind you, but enough for me to hesitate recommending it to anyone, at least near up here at its 52-week high. Still, I love their products, but I'm just beginning to worry that they can't deliver what they want to make. You see, the iWatch 2, for instance, it still takes forever for people to get it. The iMacs have been really slow to update. Those AirPods, those wireless earbuds, I mean, those things took months to get out, a lot longer than they expected. I'm just not so sure about their supply chain anymore. But, however, so far, Apple has created incredibly high expectations for itself, and it's been able to meet them. Now, obviously, your personal conviction, nor mine, is some magic elixir that's going to make your stocks go higher. But what it will do, it will cause you to make more rational decisions, not based in short-term, stock price-related panic. There are stories in various news outlets about Apple every single day, and a lot of them are negative. But really, there are only 4 events that truly matter every year. Quarterly earnings reports. Everything else is noise. But there are a lot more noise days per se than there are earnings days. So noise can and will move the prices of stocks. Our job is to cut through that noise and figure out what is real, what is important, etc., and what isn't. There's been an incredible amount of stories written predicting the end of Apple's dominance for the past dozen years. In the long run, none of them have come true. Apple has continued to grow its earnings, and the stock price has followed suit. A good example of a story that did matter recently was Chipotle Mexican Grill's food poisoning story. Real people were sick, and that made others not want to eat there as much. That type of news absolutely should hurt your conviction in the stock, and if your instincts told you to sell the stock because the reason you bought it is no longer true, then that would have been the correct instinct. That event hurt their earnings and also the demand for the stock. But also, historically, Americans forgive these types of crises eventually, and I think we might be in the beginning of that comeback for Chipotle. I live in a college town, and my local Chipotles seem to be coming back quite nicely. Athletes in particular seem to live on the stuff. This is where buy what you know comes into play. The more knowledge you have, the better. And I happen to think that your personal experiences with a product or a service really offer you just incredibly important insights. As much as possible, give your stocks give the products of the stocks that you own a try, and their competitors as well. For instance, how long are the lines at your local Chipotle at lunchtime? Check it out and compare that observation to what you saw, 2 years ago, 3 years ago, before the whole food poisoning thing happened. Now, of course, one needs an understanding of the real numbers too, and not just this anecdotal advice I'm talking about, and that is what companies are legally required to provide during their quarterly earnings reports, and also in the form of future guidance. Next time, we'll get into specifics about what and more importantly, the big money managers are looking for in terms of numbers, and also where you can find them. See you then.